So thanks everybody for joining. Tonight we're going to talk about seller finance and joined here by Justin Bogard. Justin, how's it going, man?
It's going great, Dan. Thanks for having me on, buddy.
Yeah, of course. No, thanks for joining. I think you got a fun presentation. I was looking through a little bit beforehand. It's actually pretty intense. Like there's a lot of like really good detailed info in here. So this will be one for people to probably like watch more than once potentially to gather everything from it. But maybe just like introduce yourself a little bit for folks who aren't familiar with you.
Sure. My name is Justin Bogard. I hail from Fishers, Indiana, which is just a little suburb on the northeast side of the Indianapolis section area. And so I've been in note investing since about 2016. And I got into a friend of mine, Eddie Speed. He's my mentor. And so he kind of taught me the note business. I kind of been doing that ever since. Before that, I was trying to fix and flip houses, and I was a landlord, and I did some wholesale deals. So I had, some decent training on how that, what I call the traditional real estate world works. And then I switched over to notes because it just made a lot more sense to me. And so I've done numerous things in notes. Dan and I have both had many conversations about, our tenure in the business. And so fast forward to today, I have a small fund that I manage and I raise capital for. And then I partner with Eddie Speed and I run his trade desk. Um, and our company is called Colonial Funding Group. And so we are buying and selling real estate notes, and we are more focused on portfolios than we are single one-offs. We do buy single one-offs, but we mainly target portfolios is kind of our main focus. So the presentation I have designed for today is kind of what we put in front of groups of people that are creating seller finance paper, so they kind of know what today's market is on the value and really what our best practices to create them. So folks like Dan or myself or anyone on this call that wants to buy notes, you got a pretty solid deal in front of you that you can buy and has the highest chance of success, not only for you to make money, but also more importantly, the borrower to be successful and have, a place they can live and not have to worry about going to the bank to get a loan. They can just, use owner financing to set themselves up. And hopefully in the future, Dan, they can refinance and get into the standard bank buying box.
Sounds good. And for people who aren't familiar, like a lot of people probably are, but if you're, somewhat new to this, like Colonial Funding's been around for a long, long time. And Eddie Speed's probably like the most reputable guy in the business. So, they operate at a pretty serious scale.
He's been doing this since 1980. So just a couple years after I was born.
It's about five after I was born.
Yeah, he's been doing a long time. Him and his wife, Martha, they both learned the business from Martha's father, who was doing this stuff, in the 70s and all that. So Eddie took it to another level. He doesn't have his own training, he does, but he kind of wants people to know that, he's been a note buyer since then. And he hasn't actually counted all the deals that he's done, but he's extremely confident that he's done over 50,000 note transactions.
I believe it. And for those who, I actually didn't know that about him learning that from Martha's
Yeah.
dad, but I'll send emails about this in the coming weeks. But like Note, his conference Note Expo is coming up in November, so that's definitely worth checking out. So I'm sure both him and Martha will be speaking at that.
Yeah, it's pretty cool conference. It's geared towards like non-selling. So it's content driven. They have individuals that have funds that go to this conference and they speak on stuff, and they have other things that are kind of motivational things for you as well. It's a 2-day conference, but folks that are end up being his program, they actually come a day early, and he has like a special session to catch them up on what's going on with them and the company and stuff. So
What I like about it is it's the biggest note event and most everybody shows up. So for me, it's just good for networking.
oh
Like,
yeah.
like if you're brand new to notes, like there's a lot of good content for that. For me, I've been to it like several years, but I just end up, talking to people for several days in the
Yeah.
hallways. It's just kind of like the nice meeting spot to meet everybody face to face.
Yeah, you get kind of the best of both worlds. If you kind of or you're past the basics of note investing, and you may not have to listen to every presentation, and being in the network hallway is great because there's tons of vendors there and get to talk to servicers and other people that you may be using, attorneys in the business, and actually get to see them and talk to them in person and have conversations with them. And And like you said, the networking is really, really fun there. Even after the event hours, you're all collectively in the same conference area, hotel, and so you can meet up with people and just have more conversations with them. And it's semi centrally located, between the East and the West Coast. So
Dallas, Fort Worth, right? I mean,
yeah, it's really
yeah.
close to the Dallas Fort Worth airport, or the
Mhm.
DFW, excuse me, the DFW airport.
Yeah. Well, cool. Well, let's get into it. I'll let you share screen. Hopefully, I don't run into any weird permission things. I didn't think of that beforehand.
I am trying to click share screen. It says host disabled participant screen sharing.
Okay. Hold on.
And if anyone, while Dan's
Try
getting
it
that figured
now.
out, if anyone has any questions or wants to chat specifically to Dan or whatever during the presentation, by all means, just go ahead and ping through the webinar chat and stuff. And Dan, he's a pro. He'll stop me when he needs to if he feels like there's a question that I should answer now, as opposed to waiting, towards the end. Totally up to you, Dan, how you want to handle
Yeah,
that.
what I can do is I can kind of monitor the chat. Like I know when I get there presenting these things, like I have a hard time paying attention to chat. So
Yeah.
if you want to focus on presenting, I can watch the chat and some stuff I can just answer, or I can also like ping you and let you know when there's a question.
Okay. Very cool.
Cool. All right, I'm gonna turn my video off. All right.
Cool. Well, thanks again, Dan, for inviting me to come on your webinar today. And when Dan and I were discussing what to do, and I was telling him what my main focus is right now, is really educating the audience out there on what best practices are for creating seller finance paper, and really what's market value for that stuff. So Dan, I'm sure you see all sorts of stuff out there, and you're or researching notes, excuse me, and looking for performing and non-performing. What we see mainly, Dan, is performing loans. And
Me
so we
too.
have a real good understanding of what people are creating, and then what we really should be doing with our paper. So I'm not sure how many people on this call today are creating owner finance paper. If you can, why don't you just chime in, so at least we know that there's a few people out there that we can benefit from. Dan, have you created seller finance paper a lot?
I have. I wouldn't say a lot. I've created probably five or six, maybe, over the last few years. I
Okay.
end up creating them when I have a non-performing note that I end up foreclosing on,
Hmm.
and then I sell the property doing seller finance. I always prefer to do that when I can. Often my REOs are pretty beat up, and I end up just having to sell them like the local cash buyers
Yeah.
that are going to fix them up. But whenever I can, I like to do seller financing because then I've got another note and I'm kind of still in the deal.
Yeah, I like it. I'm the cash flow person, so that stuff is exciting to me.
Yeah.
Um, so the first screen that you see up here, it says what drives the value of a note, and what Eddie taught me way back in 2016 was there's really six things that create the value of a note. And if you think of it this way, Dan, we're kind of making an elixir, and we're putting together these different ingredients. And within these six main ingredients here, we really can determine the note's value. And the first one that just shows up on here is the buyer. The collateral, obviously, that's important. The buyer's equity, right? How much skin do they have in the game? The actual terms of the note and the loan itself, like what are the details about it? How are they repaying this back to you? The payment history, if there is any, that's very important, and we'll get into that a little bit later. Then obviously the documentation that they use, not just the terms, but the actual documentation. Dan, I'm sure you've seen some weird paper out there that just, doesn't really work well with the attorney when you're trying to foreclose on it. You just want to make sure the paperwork they're using is solid. So I'm sure you heard the
Yeah,
term.
I've seen all kinds of weird stuff. Like you're basically making sure that the loan you're buying is enforceable so that if
Yes.
you need to, you can foreclose. And also that the title's clear. Like there are cases where you might be able to foreclose, but there's some like lien in front of you or some other issue. That's a problem.
That's
And
actually a good webinar for another day too.
yeah, that you can go deep on that one. And by the way, I know somebody commented in the Q&A that the chat's disabled. I'm trying to figure out how to enable the chat for people. I don't know why it was
Oh,
disabled by default.
okay. Well, please use the Q&A, I guess, until we get that figured out.
Yeah.
So So these are the 6 values of the note. They all are not going to be an A. They're all not going to be an F. They're going to be B's, C's, maybe D's and A's, a mixture of everything. And you can weight them all, as well as you can. And the overall score is really what you're going after to get a solid note. And so when you see some of the stuff we're going to do later in the presentation here, you're going to see what I'm talking about when you have some things that are poor, but some things that are really good that kind of help overcome that and make it, average. So everybody, the first thing they want to know is really what's the yield on the investment, right? What does my future cash flow look like? And what is that metric that I can associate with, so I know what type of return I'm going to get, as far as if I like that return number or not. Returns are all over the board, and it's based on many different factors, but most people are looking for that double-digit return. Well, when you look at this graph here and you see, like, you're starting with the green glob, and the chemistry is moving over to the next beaker, the next glass there, and then it goes even more refined. So the 8% is like the most refined. It's like, the best note out there, let's just say. And 12%, it's a little bit not as great as the refined one. And then the raw, I'm going backwards here, the raw stuff is the 14%. So I always tell people, if you want high return, you're gonna have to take on some more risk. If you want way less risk, you're going to get a lower return, right? They're both proportional to each other, right? Right, Dan?
Absolutely. And I think where I've seen people get stuck sometimes is they're like, well, I want a really high return because I'm an awesome investor, and I want really low risk because I don't want to take any risk.
Yeah.
And they end up just wasting a lot of time, and they never actually do any deals, right? So you have to understand the market, and you want to pick and choose. You want to be very choosy, right? And very selective, but at the end of the day, you got to recognize that there's that trade-off between risk and reward.
Yeah.
There are no freebies. Yeah.
Yeah. I like to do a mixed bag of both. I have some very conservative ones and very aggressive ones in our portfolio. So I have a pretty blended portfolio, and they're probably small notes and large notes and mixture. So I'm not all just one way or the other. I just mix it up just personally.
You do something similar. I tend to be more conservative in my self-directed IRA, and I tend to be more aggressive in my LLC.
Yeah, that's a good point. The bucket of money of where your pool of money is coming from, that is important. So I would definitely recommend not doing non-performing loans in your IRA. I'd rather do those with cash than I would in my IRA. I'd rather have performing loans in my IRA, just personal opinion. Pricing discounted notes for performing notes, that's what we mainly are going to be talking about today. You're going to be looking anywhere from 60 to 95, what we call cents on the dollar. So that's the percentage of current unpaid principal balance that the loans are going to be paid for. And the reason why that range is so broad is because there's too many variables to take in consideration. Sometimes first-time investors will come to me and they're creating loans, and they'll say, okay, how much will you pay for a note if I just create one? And it's like, well, there's a lot to it. Like, would you just buy a used car off a used car lot without actually looking at the car? I mean, no, right? You wouldn't actually do that. So there's all those 6 values of the notes. We need to kind of research and figure out what is inside each of those values so we can understand them. So within those 6 values, we're going to kind of break them down individually for you. And I got some graphs and stuff that I'll go through. I promise I won't take a bunch of time doing this, but I also, if I know if I go too fast, it'll be, you'll miss something. So the buyer, Dan, we got to underwrite them right before we create that note. These are probably simple things that you realize, but you don't really take into consideration as using them as kind of like a checkpoint to go through, or a checklist. You want to, verify their income. You want to understand their debt to income ratio. You want to look at their credit, their payment history with the previous residents. If they have rent from a previous place, you want to understand what that is. What is their job situation? Are they in between jobs? Have they held a job for, 10, 12 years with in the same business, the same company? Like, how's that stability? So what we do is we take, oops, I'm sorry, I'm getting some feedback there. So what we do is we use what's called an RMLO, and that stands for Residential Mortgage Loan Originator. And they can qualify this borrower to make sure that they have the ATR, the ability to repay this debt based on the note terms that you laid out. So they go through all this underwriting for you. You don't actually have to do that, but I want to list them out there as that's kind of like the basics thing that they go through.
The other thing I'll call out, like if the borrower, if this is gonna be their primary residence,
Hmm.
like you're legally obligated to do this stuff, right? Like if you don't follow the Dodd-Frank guidelines, and then the borrower immediately stops paying and you have to foreclose and you get to court and they say, hey, I stopped paying so I could never afford this. I didn't know what was going on. Then you could get yourself in trouble. But if you use that RMLO, then you'll be in good shape.
Absolutely. That's a very good point. And thanks for bringing that up because you're exactly right. The Dodd-Frank and CFPB rules, you want to stay within that. There are some, you can do a couple of them per year and not have to use an RMLO. But really, why would you not want to use the RMLO? It's setting things up the right way. I'm here to teach you guys what we would want to see, Dan and I, as note buyers, especially on newly originated loans. Like we really want to see that credit profile on them and all these things about that. The reason why this message is highlighted down below is because I want you guys to write this down and use this when you advertise for selling a property with owner financing. We actually want to remove the word owner financing and seller financing and replace it with private financing. And you want to write the message as this. You can say home, for sale by owner, and then you can say private financing available to deserving buyer with large down. You can say all those words. So why do you think I say it exactly like that, Dan?
Well, for for one, it seems like a lot of people get confused when you say seller finance. A lot of
Mm-hmm.
people don't know what it is. And the second one is, I don't know if this is where you were going or not, but in theory, when you create this note, the seller doesn't necessarily have to hold it, right? Like you could arrange the deal where you have an investor that's going to provide table funding and they're going to fund the loan, kind of like a bank would in a traditional transaction. I'm not sure if that's where you were heading or not.
Yeah, we just want to kind of put the baseline out there and say when you're advertising for this stuff, this exact verbiage, verbatim, if you will, this is going to attract the right buyer. This is not going to attract the person that has $500 to put down on a house. That's obviously not the person you want. They need to have some skin in the game. Otherwise, they have no, equitable interest in the property really, so they can just walk away at any time and, cause you a bunch of headache. The other thing it does, the word owner and seller financing has a negative connotation mentally or subliminally, I should say. And when you say private financing, it's like, oh, okay. So I don't, it's not just for people that have broken credit or bad credit. It's like, okay, there's financing available out there. So that's why we say it like that.
Yeah, and most sellers are going to have no idea what they're doing, right? So like
Yeah.
seller financing almost implies like an amateur
Yeah, no, exactly
setting
what I was
this
going to
up.
say.
Whereas if you have an RMLO in the mix, that's not really the case. And so, yeah, I see what you mean.
Cool. We had a couple questions pop up. Did you want to answer those from the chat? Looks like the chat got enabled.
Yeah, let me see here. Let me catch up on these. Now I got distracted. So you have to have a loan officer license to create a note. I think you started to mention this one, but
Yeah, so no, you as an investor, you don't have to have a loan officer license. The RMLO is the licensed person that can originate the loan. So you actually would be the loan originator, but the RMLO can act as that for you. And so that's how you do this in a way that you're not looked at as a predatory lender. So no, the RMLO, which Dan and I both know a few of them that can do most of the states in the U.S. Some of them, for some reason, don't choose not to get their license in certain states for some reason. I'm not sure why. Maybe it's a fee thing, or maybe it's also a
I can
debt
tell you
collector
why on
license in
some of them.
addition. So
I've been nerding out on some of that stuff lately. Yeah. So some states are just more difficult than others to work in. It's kind of what it comes down to, I think.
yeah. So um, the process for the RMLO, honestly, it can probably take a couple of days as long as the borrower provides all the information they need. Look, they're just looking at getting, all of their income and understanding all of their liabilities and finding out does their debt to income and payment, to income ratios match what they need to be. And there are certain percentages out there, and I don't want to overcomplicate it for today, but you want to let the RMO handle that, and they basically give you a breakdown file of exactly what's happening with the borrower so you can read through it. And if you need help reading through it, obviously you want to you can talk to your RMLO about the specifics of it, or ask another note investor that does this stuff as well to help you read through it. But it can be very cumbersome, which is nice, but it also, the borrower understands, like, oh man, they're asking for all this information. I better make sure I can afford to make this payment. Otherwise, you want to stop right there and not go forward. So all this happens before you even get to the closing table. We typically like to do it as soon as the agreement signed with the borrower to purchase the house. We put them right to underwriting. So that's why I say it usually takes a couple of days, probably 48 to 72 hours at the most. And it all depends on if the RMLO has all the information. I saw that question pop up there, and I thought that was a good question.
Where they can like I've had these take like a couple days and go super fast. Where it can take longer sometimes is like if the borrower is self-employed and the RMLO needs more documentation, like sometimes that can get a little bit cumbersome, but generally
Yeah,
goes pretty quick.
it does. All right, so that's about the buyer right there. So the collateral type is obviously important. I mainly deal in vacant land or single family residential, so that's kind of the wheelhouse that I'm typically in. So I'm dealing with owner occupied stuff or vacant land. So what's the buyer profile in the area? Is it renters or is it homeowners? What's the neighborhood like? Is it near a golf course? Is it back up to like a real beautiful lake? Does it have railroad systems going through it? Like, get an understanding of where the collateral is at. The condition of the actual collateral, is it in poor condition? Is it just typical for the area? Maybe I call Indiana, it's the typical Midwest Indiana home, blue collar state, blue collar property. What's the price point? Is this, $100,000 homes, or is it $300,000 homes in this area? Um, and then for land, is this a bankable piece of land? Meaning, can you go out and get financing for it? Banks are typically a challenge to go out and get financing for land unless it's, solid land. You obviously don't want to go to places where I've bought land before where it's swamp condition or it's just not good. And the most important thing about land, we always ask, is can you sell it with a realtor? Like, that's the highest valued land that you'll run across, because it's easy for a realtor to sell land when it's really nice. It's marketable to somebody. It's appealing to somebody. We can get into more specifics about land, but that'll probably put us down a rabbit hole that'll take too long. So the buyer's equity. So in the beginning, obviously, when they own or finance, the more the down payment is, the more skin they have in the game, right? So it's the cash down. If the loan has been seasoned for a while, so we say newly originated loan, that's really anywhere from 0 to probably, 8 months or so. That's kind of still new. So their appreciated equity, like this, is the value of the house gone up for some reason to where they've had more equity? Can they sell if needed? That's important. So can they sell? Meaning, can they sell it and be able to get a profit on it? Can they sell their house, pay off the mortgage, and still have money in their pocket? So the terms of the loan, this is where we get into the rates. The interest rates are going to be all over the place. It really depends on kind of property value. So I play around with a matrix sometimes, and so I find that the higher the interest rate is usually the lower in loan amount, and the lower the interest rate is usually the higher the loan amount. So basically, as you go up higher from 100, 150, 200,000, 250, 300, the interest rate's actually going to get a little bit lower each time, because at some point, a 12% interest rate on a $400,000 house just becomes unaffordable. The maturity date is we call it, how short is the yardstick? So is it like, has it got a shorter balloon on it, like a 5, 6, 7, 8 year balloon? Or is it a 30-year amortization? Is it a 20-year amortization? Is it 15? What does that look like? Fully amortized as opposed to not fully amortized? Or is it skipping around with the rates? We don't really like to see the rate jumps on loans. We just like to see a fixed rate on it. It just makes everything a lot less complicated on it.
Yeah, a lot of those weird features, they call them like high risk features. Like
Mhm.
generally I like the loan terms to be just super simple. If it gets too fancy, nobody's gonna understand it, and you're kind of like setting the borrower up for trouble, I feel like.
Yeah. The confused mind says no, right?
Yeah.
So balloons, you want to be careful of this. This is where your RMLO will come in handy. On an owner occupied loan, which means the borrower has their primary residence, you can't be making a 1 year, 2 year, 3 year, 4 year balloon. It's got to be at least, I want to say, it might be able to, you might be able to do 5, but I think it's actually 7 or 8 years is probably where they like to see it now. There's some arguments for and against that, but I would, if you're going to put a balloon in there, I'd probably put it out at least 7 to 8 years.
I'm not a fan of the idea of balloons on like residential loans. To me, that's more of like an investor thing where like, okay, the investor is going to refinance out or, do something else later on. I feel like in a residential loan, that's just asking for problems.
And if you make the balloon or the yardstick too short, what happens is there's a metric that we call balloon to value. So if the balloon amount is really close to, let's say, 75, 80% LTV, a bank's not going to refi it. They want to see some more equity in it before they refi it. So you obviously, for that other reason, not only for Dodd-Frank and CFPB compliance, you don't want to have you can't have a short balloon, but you also want to make sure the balloon's out there far enough to where the borrower is going to have, some significant equity in there. So when they do refi, it's going to be a lot easier. So you're, hoping for a little bit more appreciation 7, 8 years out. And also they put down a significant down payment. So is the balloon enforceable, right? Can the borrower refi to pay off the balloon? Those things we talked about. So when we talk about amortizations, the shorter the note term, it actually benefits you as the note holder. You get your money back sooner. And then if you want to sell the note, you also have a better chance of the note buyer not having to discount it as much. If you look at a 30-year amortization versus 120, what happens is the payment is a lot higher the shorter the am, and the longer the amortization, the lower the payment. But then also the longer the amortization, we got a ton of interest that's built up over many, 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 many years, right? But as someone that owner finances properties, you will eventually need to liquidate that note. At some point, you will run out of money if you're doing this at scale. And so if you make the terms, a little bit shorter, it's going to be better for you. So the longer the term, it's going to be less valuable to a note buyer because they're going to ask for some more discount because they're actually buying the cash flow over the long term. And so that's why that comes into play.
The interesting thing about that to me is I agree as like the note holder, I like the shorter term, it's more valuable. And in general, the government considers a shorter term better for the borrower as well. I think because they're not paying as much interest
Yeah.
over the life. So it kind of works out for everybody, assuming the borrower can afford to make the payments and you meet all the ability to repay requirements and all that.
So what we're looking at now is it's kind of an inverse yield curve is how I kind of look at it, because we're flipping the yield on the investment, the graph that we usually make, we're flipping it upside down and rotating it left to right. And so when it's upside down, this is what it looks like. And this is the present value of a future payment. So if you look at, this is just math in Excel. There's nothing fancy to this. So let's say that the borrower pays $1,000 a month is the P&I payment. But let's just say this is like, I don't know, like a 6 or 7% interest rate note. So you notice in the timeline on the x-axis that goes from left to right, 1 to 3, let's call it 360 at the end, you notice how the graph kind of slides down. That's the value of the payment. So if you're looking forward as a note buyer and you just buy one payment, well, you're probably going to pay full price for that note. You're probably going to pay $1,000 for that next payment, right? That makes sense. If you wanted to buy 5 years worth of payments, then you're looking at probably it's the value of each payment is worth $600. So you take 600 times 60, and that's what you would pay for the note. So as you pay for more payments going out further in the future, the value per payment becomes significantly less valuable when you buy it today. So that's an overcomplicated explanation of the future value of money, but that's why we have to discount a note. And so I just don't want to beat that up too long because we can go down a rabbit hole pretty quickly, but I just wanted to show you guys that's why that graph illustrates the future value of a payment. Okay, so let's just talk about a loan here. Let's compare a long note and a short note. So let's say we have a $100,000 loan amount, a 6% interest rate. The payment's $599, but the term is 30 years. So obviously Dan's going, oh man, that's going to have a huge discount in there. And that's exactly what's going to happen because the amortization is so long and the amount financed is low in our eyes compared to, when we see $125, $200, $300,000 loan amounts, it's just so long that the borrower has a $600 payment. It's going to take them forever to pay this off. So it requires a heavier discount because the interest rate really isn't market value. What would you say off the top of your head, Dan, market value rate is on that specific note right there?
Yeah, so back to your like earlier slide, right? Like you were saying, based on the riskiness of the loan, you might price it to yield 8 to 14% or something like that, depending
Yeah.
on what it is.
Hmm.
So like just making up numbers, like let's say if I'm going to discount this to 12%, because that's where I feel like it fits in the risk profile, then I would be, yeah, it might be in that like 60% of UPB range. That's just off the top of my head.
Yeah. So it wouldn't be out of the question that a note like this, the rate probably should be between a 10 to high 11% range, maybe even a 12, depending on the collateral. Probably wouldn't do 30 years, probably do a much shorter term. But yeah, that's the reason why this particular note would be discounted so heavy is because it's got a low rate and it's extended very, very, very long out there in the future. So again, breaking down that graph a little bit easier for you. So if you look at just the shade of blue that came in 5 years, if Dan's paying 5 years of this note, buying a partial, if you will, okay, those payments are gonna be worth about $600 per payment. That's what he can pay today for them. In 10 years, he's probably gonna pay less than $400 per payment per $1,000 payment. So every $1,000 payment he's gonna pay less than $400 for, so he can get his return that he wants. And again, in 15 years, you're looking at almost $200 a payment, and then stretch it way out here, another 15 years to 360. If you're buying a newer note, the payments it's worth, let's just call it $100 or less. Let's go the other way with that example. Let's say that $100,000 note, 6% rate. But wait a minute, let's juice that P&I up by making the term super short. Well, now you got a problem to where, can the buyer actually afford that monthly payment? So this is why you can't be polar opposite on either side of this equation for this example of a 6% rate, $100,000 note. We went from 30-year, which was $600, and we went to 60 months, which is almost $2,000 a monthly payment. It's probably not going to be affordable to that buyer on a $2,000 payment on a $100,000 note. So you have to keep that in mind, which is why we like using the RMLO, because they can make sure that the borrower has the ability to repay that debt. So if their debt to income is 80%, they're not going to be able to swing this. So pay history. This is what I like the best about notes, especially when they're seasoned versus unseasoned. You can forgive a lot of stuff when they're seasoned. So proving that they can and will pay is really that the pay history does. On a newly originated loan, they're not really going to have a pay history, so that's why the credit is so important in the beginning, as opposed to having, I don't know, Dan, like 2, 3, 4, 5 years of pay history. The credit really doesn't matter, right? Because you have the story in front of you of the last, 36, 60 months of payments that came in from the borrower.
Yeah, when I'm buying existing loans, I really don't care about the borrower's credit. Like to your point, I'm just looking at their track record. Either they paid reliably and it's lower risk, or more than likely the stuff that hits my radar screen, like they haven't been. And so I know they're
Yeah.
higher risk.
So there can be redeeming factors with payment history when you have a weak buyer and weak collateral. That can help overcome that, because you can see the pay history. They have some skin in the game, and then they have obviously emotional equity as well. And so that's how you overcome that stuff. So what if they have great credit? Well, that's good, right? We all want to see them have great credit and that they pay their other creditors well. Okay, so let's get back into poor credit, but they got a good track record. So this is what Dan and I were talking about. We're not really worried about having bad credit if we have a pretty good season loan, meaning we see many payments. I consider a good season loan about 24 months. Obviously, we still buy loans that have less than a 2-year pay history or even no payments at all, depending on the situation. But when they have poor credit, this is what overcomes that, just like what Dan was saying. So now you can raise your cost basis on this note and pay, 70, 90 cents on the dollar for it if it has a good payment and a good track record, regardless of the credit. And that's how you overcome that. buying an unseasoned note with poor credit, well, you're basically rolling the dice out here. So you're buying an unseasoned note and they have poor credit. What's the likelihood they're going to continue to pay for however many years you own this paper? It's not looking in your favor. So they take on a lot of risk for defaults and delinquencies. What do you think the propensity with poor credit of a borrower is within 2 years? What do you think the default rate is?
I think that's gonna depend heavily on the down payment that they made.
Could
If
be.
they if they made like 10% or less, I'm gonna guess maybe a good like 20% chance of it going south, maybe more.
First 2 years. This is the most important with bad credit borrowers. And we're talking bad credit, like probably closer to 600 to definitely under 600 bad credit. There's a 20% chance of
Ooh,
default.
and I did not look ahead. That was off the.
That's all right. That's why we're here. We're all here to learn. We're all here to see, what loans are doing. Eddie and I are seeing probably on average between probably 12 to 1,500 loans every quarter that we're pricing, whether they're portfolios or one-off loans. And so we're seeing a lot of people that are originating loans, and with Eddie's track record, and obviously I have a little bit of a track record too. This is what we see that's very common. If they have poor credit, there's a 20% chance of default rate in that first 2 years. Once they get past 2 years, though, hey, that's what the redeeming factor is. It's you can get past the first 2 years of bad credit. There's a lot better chance of success there because we'll call it 5 to 6% chance of default at that point.
Yeah, you guys have the advantage, right? Like a lot of these are rinse and repeat. Once you see a lot of these, you can see the patterns.
Yeah.
And so it's nice to have that experience. What I've kind of noticed recently is once the borrower is paid reliably for a few years, if you do hit that 5 or 6% chance of default, it's usually because the borrower passed away.
Yeah.
At least I've had a few of those lately.
It does happen. It does happen.
Yeah.
So let's look at the picture of a house so you can see when a note buyer wants to buy a note. We obviously, just like when you're buying a property, if you're buying it to fix and flip or being a landlord, who wants to pay 100 cents on the dollar for that? Does anybody want to for a house?
On the golf course? No, I'm
On the
just kidding.
golf course? Yeah.
Yeah. Golf.
Backed up to a lake with its own
Yeah.
dock slip. Yeah. So the same thing in a note, like they're not just for the time value of money and the yield investment, but we also want to make sure if we're investing in that note, we're not going to be paying, close to value of the actual house. We want to have some cushion in there. And so our investment dollars in a note, they want to be, not up there. So I'd probably say we're going to be under 80%, a vast majority of the time of whatever value is today on a house. We're definitely going to be under 80%. 80% loan to value. So now with a down payment. So the down payments that we like to see are between, realistically, it's going to be 10 to 15% is what you're going to have to aim for. We have seen many people create loans to where they're able to get 20, 25, 30% down payments, and that's great, and that makes it even better. But if you get one that has a 5% down payment and you have a 95% LTV, you're not going to find anybody that's going to pay 100 cents on the dollar for a note to begin with. And you're probably not going to find somebody that's going to pay close to 95% LTV on that note either.
There was another question, Justin. Like, how do you adjust the value for a note that's placed with a servicer versus self-serviced?
Great question. A lot of, let's call them mom and pop seller financiers, they service their own notes because they honestly don't know any better. They don't know the rules and regulations on, having to collect the borrower's social security number so they can send it to the IRS to give them credit for the interest that they made for the year on the loan. Like they don't know about that stuff. I would consider a note that is serviced with a third party professional licensed loan servicer much more valuable than a self-serviced one. To be honest with you, when you buy a self-service note, you got to go through all the bank records and how they track the payment and how they received it and have them sign affidavits. Like it's a big pain in the butt when you buy it. And then who's to say that it's all really verified except for using an affidavit? We'll have to do a borrower interview to make sure they agree. And so it's just a big hassle, but it's just a lot better for everybody if the note can be serviced by somebody. Quite honestly, they have companies out there that are pretty inexpensive for a note. So they anywhere from like $15 to $35 a month per payment per loan is what we see out there in the marketplace. So obviously, if you're getting $1,000 payment that comes in, I mean, spending $35 on servicing fee per month is, kind of a drop in the bucket. But if you have $100 payment coming in, spending $35 a month on a loan, that's not very good. You don't get a very good return. We typically don't like to see payments under $500. The borrower it doesn't seem that they just if they're struggling to make a $500 payment, they've got a lot of things going on that's not in their favor.
Yeah, the big problem to me too, if you don't have a servicer, so I've done a lot of foreclosures, and when the borrower is going to show up at court and basically lie or try to create confusion to drag things out, which happens a lot. The number one thing I've had them say, I've had so many borrowers say this, they go, "Oh, I sent in all the payments, the loan servicer lost it." I've had so many people say that, right? And so it's nice when you go, well, it's placed with a licensed loan servicer. They do thousands of loans. Here's the statements, blah, 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 right? If you got a shoebox full of receipts that some dude gave you, that could get dicier,
Yeah.
because judges are going to tend to, if there's gray area or confusion, they're going to tend to err on the side of the consumer. Now, granted, like most likely it won't come to that, but I like being covered. It's just asking for problems. I feel like if you don't have that, and it takes work off your plate. Like I don't want to a servicer, and they have to comply with a lot of regulations.
Yeah. Dan, are you still got me? I wasn't quite getting all that you had on there. Okay. I think I'm not sure if Dan's audio dropped out, but if you guys can hear mine, let me know.
Yeah, sorry, mine's
Oh,
kind of messing up and going in and out. I'm trying to.
okay.
I'm on a. Okay, I think I got it fixed now. Sorry about that.
It's okay. I think I got what you said. You just it's way better to have a servicer run this for you. Don't give yourself brain damage. They're going to run the correct principal balance, especially if you have a daily interest rate on the loan. That matters when the borrower makes the payment. We typically don't like to see the daily interest rate on that loan just because it is harder to do that math. It's just more reliable when it's just, on the yearly basis, so to speak. So, yeah. So
Yeah.
when you make a 5%, and a 95% LTV loan, it's weak equity and the buyer's credit's probably injured. That's just cause for disaster there. It's going to be really tough to sell that loan. If you do, you're going to take a huge, huge loss on it. So if they do have poor credit and it's a new note, I mean, you're looking at a 50% investment to value ratio. Again, it would help if they had a significantly larger down payment, like a 30, 40, 50% down payment. But most of the time they're not. If they have poor credit, they're just not going to have that big of a, they have no credit. It's actually better than bad credit. But if we see that 24-month payment history, well, hey, look, I overcome that bad credit and we can probably get up to 75% investment to value ratio, meaning how much will we pay for the note versus the value of the property today? That's what that means. Paperwork. Okay. Homemade or homogeneous. So how many times have you seen documentation, Dan, on a contract for deed or land contract, and it's just, you can tell it was written by, a fourth grade student. Like it's barely even one page. It's like doesn't have really any of the information in it. It may not have the maturity date. It may not even have the payment amount in there. It's like very vague. Like you have to be very specific in your note when you create it and make sure that there is the exact information you need in there. When's the first payment due? What's the default rate? What's the late payment on it? When is it due? How much is the payment? Is there provisions for escrow in there? All these sort of things need to be baked into that note. And so that's what makes it very clear and easy to define and enforceable. And that mortgage deed of trust is just making sure that everything is secured to that collateral, making sure you have clauses for, keeping up with taxes and insurance and things like that, and securing the property. So we always have an attorney draft it. Typically, a title company that you work with is going to have a counsel, attorney counsel there that's going to be able to draft that for you. Most of the time, the originators can actually find the note and mortgage or note and deed of trust for you and go ahead and do the whole loan origination for you in like one fell swoop.
Yeah, I've definitely seen some weird land contracts out there, and a lot of some states, like I think it's North Carolina, maybe some others will have some like specific rules that's why you want to hire an attorney in that state because they're going to know to put in like certain clauses that might be required. Otherwise, you'll just miss it.
I've never tried to download one off the internet or use somebody's note and mortgage or land contract. I always pay to have somebody draft it. Typically, it's not that much money, and you can honestly put it on the settlement statement and charge the borrower for it.
I've done the same. Yeah, it's usually like maybe a couple $100 or something.
Yeah. So you'll make sure it's a valid lien, on the property, and make sure that thing is insured with title insurance so that you have an owner's policy when you transfer the property to the new buyer. And then also want to get a mortgage lender's policy as well to make sure that's got a good lien on it. Because you don't want to be in second position when you're supposed to be in first position. Make sure it's
We'll do that.
Dodd-Frank compliant. It just comes right up there. Beautiful. Qualified mortgage. Protections. All these things that we talked about, you just want to have your attorney handle it. Again, you don't have to be the expert in any of that specific stuff, but you have to know somebody that is the expert. Insurance, taxes, taking care of the property. If you look through any mortgage that's done by a bank that you've gotten it from, you'll probably see provisions in there about making sure the property is well maintained. Okay, so I'm trying to buzz through this because I don't know how much more time we have left, but I don't want to take up.
I got time. I can stay till whenever. So
Okay. All right. Is there any questions on the board before I start getting into more fun graphs?
no, I don't think so.
Okay. All right. So when we look at loan portfolios, not all the loans are created equal within a portfolio. They may be off by some interest rate. They may be off by when they originated by a few months or a few years. So when we graph a portfolio, we really are taking the aggregate of this and try to balance it and take averages based on, the amount of monthly payments, the total UPB, and what the average interest rate is and the average, term on that's left on the note. So we're trying to pretend like, I made this imaginary portfolio out because I just wanted to show you what the graphs look like. So this is $1 million portfolio. Let's just say they have 10 $100,000 loans in there at 10% interest, and the monthly payment happens to be 8,775 a month in total for all 10 loans per month. Okay. So the orange part of the graph is the borrower's amortization. So this is what I'm calling the yield curve. It's not properly called that. It's just an amortization schedule shown on a graph. So from payment 1 to payment 360, that's what it looks like. So when the loan curve starts to fall faster, that's when they're paying more principal. When it kind of goes more horizontal, they're paying a lot more interest and the principal is not falling down very, very fast per month. The red line, that is where you are buying at a discount, let's say. So you got the $1 million portfolio, and let's call it that's 85 cents on the dollar. Let's say it's 850,000 for the portfolio. So that orange spread in between there, when you sell the note to someone, let's say Dan buys it, that's his discount that he didn't earn, his unearned discount that he can get over the life of the loan. So if it pays off early, Dan can just shoot a vertical line straight up from whatever payment it's at. Excuse me. And the difference between the red and the orange is actually his discount that he can get at that point that was unearned. So if you pay and you have a well-written note, let's say, and they got good interest rates, got good terms, good collateral, the borrower's good, it's got, good equity. All these things are favorable. We're going to pay a higher cents on the dollar for that note. Let's say they're all, 80% LTVs or better or lower, excuse me. So we're going to pay a premium for it. So we can pay $850,000 on this $1 million portfolio. Let's look at it a little bit differently. So when we buy a partial of the portfolio, there's many things that this does, and we probably won't have a chance to get into all of it. But what if we just pay for 73 cents on the dollar for the portfolio today? So we're paying, let's call that 12% less today than we would paying for the entire portfolio over the entire term of it. So we're just paying for the entire portfolio, but we're only buying so many payments. I think that's a 15 years, Dan, if I'm seeing that right on the blue here.
That's what it looks like, yeah.
So this is what we call a partial. So we're not buying a partial of the payments. We're buying a partial of the amortization schedule from payment 1 to payment 180, which is 15 years. At payment 181 is where the loan reassigns back to the person that sold us to. So if Dan bought this from me, he's going to be buying the first 15 years of the amortization schedule of this portfolio here. And I know not all the loans are going to be the same amortization term, but we're just using kind of an aggregate here. And then at payment 181, theoretically, as long as they haven't paid off early, all those loans will revert back to me. So that means I would get, let's call it 73 cents on the dollar today for my paper. And then in 15 years, we'll draw a vertical line up and we'll go to the left and look at what we got there. I got another $816,000 owed to me. 81% of today's balance I get in the future. So this is a wealth building tool for people that create many owner finance loans, and they can repeat and do this over and over and over again. And they have just these large buckets of income that are coming in the future that they have no cost basis in. Pretty cool little trick.
So and I like I haven't actually executed on this one myself, but I like that kind of strategy for like a self-directed IRA where you don't need the cash right away. Like you're saying, okay, I'm going to retire in 10 years or 15 years. You can architect these things. So basically like the money shows up when you need it.
Yeah. So remember when you buy this from me, Dan, I'm not getting any cash flow, but I did get $731,000 that I can go out and buy more inventory with, right? Mm-hmm. And then in 15 years, I got another $816,000 that's coming to me in the form of cash flow monthly, or most likely by then, several of the loans are probably going to be paying off before that point anyways. And then Dan gets what's owed to him on the blue line. And then whatever's the remainder between the blue and the orange, if you go straight up, that would be the extra money that I would get then. So when you have when you think about this from a tax perspective, this is considered an asset sale. And so really you're just going against your cost basis. So let's say, Dan, that you had, I don't know, $650,000 into this portfolio that you have of cost basis. And I just gave you $731,000 today. Mm-hmm. So are you paying taxes on $731,000?
Nope.
That's right. Mm-hmm. That's what's cool about this. I'm not a tax advisor. I'm not a CPA. I'm not a financial advisor, but this is a tax strategy that you can talk with your accountant and your CPA and discuss, because this is an asset sale. We know that for sure. And so that's pretty cool a strategy. So then in the future, you can just get, your income off the interest. It's almost like kind of like a built-in 1031 almost.
Yeah.
So that was a lot. That's my last slide before I get to my informational stuff. So I wanted to kind of pause to see if there was any questions or if everybody dropped off because I was too boring.
No, people are still here. That was awesome. Thank you. But that is a lot of info. Oh, so someone asked, like, can you explain why it's a built-in 1031?
I'm just using that word facetiously. It's not really a 1031. I'm just saying it's kind of like a 1031 where it's like a tax sheltered thing.
You do it in exchange and you're not paying
Yeah.
tax on it, kind
Yes.
of. Yeah.
Exactly. Like a 1031, you're taking a property that you have and someone else is holding it for you, kind of like a trustee. And they're saying, okay, I'm holding your money here until you find the next property that's of equal value or more. And then we're going to use that money to fund that deal. And then you don't have to pay taxes on it. And you keep doing that over and over again as long as you follow the rules. I was just saying it's similar to that, to where, you have your cost basis of, we're imagining I had a cost basis of 650,000 this deal, but then Dan gave me 730,000 today. Well, my cost basis was 650, so I just got pretty much all my principal back, and then there's just a little bit left over that you'll probably have to pay some taxes on. But it's way better than paying taxes on 731,000 today.
Very good.
So,
So
anyways, it's kind of out there. I know the math sometimes is not hard to believe when I go through these slides. I hope I didn't go too fast for people, but honestly, if you want to create loans, use some of these techniques that I've showed you today and take into consideration, how a bank would underwrite a file. It's still up to you if you want to move forward with it. It's just, if there's certain thresholds that you really don't want to go past and you don't want to make sure the DTI is too high, and you want to make sure they have, a good credit score and a good down payment, you can still create a loan, with bad credit and low down payment. It's just the ramifications of that decision are going to be, you're going to have to wait quite a few years to sell it to a note buyer without taking a big haircut.
yeah, so I mean, things to factor when you're creating the notes, there's controlling the level of risk so that you have a good note, but then also, yeah, if you're looking to sell it or eventually sell it or sell a partial, like you want to create the most valuable note, that you can, and all these terms kind of play into it.
Yeah, because then you can have your cake and eat it too. So if I was able to do this and I had my systems and people and vendors set up, I would be buying properties that need a little bit of rehab work, not a monster amount, and I would be reselling them on owner financing with the same model and the same criteria, and I would be trying to hold that paper as long as I could until I had to sell it, and I would just sell a partial, and I would just try to repeat and rinse as much as I could. Sometimes you have to sell a full loan because, as much as you would want to do a partial on every deal, it's just not going to, the math's not going to work out. You do need some money to eat. So it can't work out in every situation, but it is a way to do a blended portfolio of selling fulls and selling partials, to recapitalize.
Yeah,
But
and
I would
then
hold
there
on to that interest as long as you can.
was another question. Does Colonial sell individual notes?
They do sell notes because we do buy them to sell them. Our our system is set up for the students of note school to come in and buy assets. So we do
Hmm.
sell them, but you have to be in the mentorship program of note school in order to buy them. So we don't publicly sell them anymore. We used to because
Okay,
we had
because
a
they used
fund.
to. I never bought from them directly, but I know they used to. Yeah.
Yeah. So we had a fund and we raised monies, for several years. I think about 3 years ago, they started to sunset that fund. They finally wiped away all the inventory and they stopped. They had a platform called Notes Direct, and then they just stopped doing it because it became very difficult to run the fund, to be honest with you, and it also became difficult to manage, the platform, and so the focus just changed to let's just deliver good product to the people that want the training from us, and that's what they want to focus on is make that a value add for it. So that's really the reason why we do that. Is for that
Gotcha.
reason. So we don't sell them publicly to people. Now, if it doesn't fit what we try to do for our students, then we do trade them out to other people. It's usually like bigger portfolios. Like
Hmm.
we have a $34 million portfolio that we're trading right now, and obviously we don't have a student to take that down. So we find other institutions to work with and to trade deals with them, that we run across that don't fit the buy box of what we typically see for our student.
Got it. Cool. Well, Justin, thank you very much. Maybe we can go to the end or.
Yeah, this is just the last slide. It's just, if you do want help creating a loan, or if you do need some, I guess, let's just call it a guideline to go through, and you're planning on originating more of these, we're happy. We don't have to buy loans from you, but we really want to give back to the industry, which is why I wanted to share this, with you guys from Dan's group on what we see. We see a lot of loans come across our trade desk, and we see a lot of newer owner financiers, or what do you want to call them, seller financiers. And there's just some things that they need help with because honestly, they just don't know what they don't know. And so vacant land, we really didn't get into that too much because I'm not going to assume everybody on here wants to do vacant land. It's actually what we like to buy the most is vacant land. It's kind of how Eddie started off with. In Texas, there's just tons of land that people buy and break up tracts and sell on owner financing. It's pretty cool. Texas alone, Dan, does about 25% of the annual business for the country and just owner finance paper.
Yeah, Texas has always been kind of the hub
Yeah.
of that, it seems like.
Yeah. It's $28 billion a year in Texas could account for about 25% of that. So over $1 billion, you know, Texas is accounted for.
And I'm guessing a lot of that is because they've developed a critical mass and there's enough people there that know it, right? So to get on my soapbox a little bit, I was saying like it's nice to educate people on this stuff, even if you're not going to do a transaction with them right away. Because just like the more people that understand this and know how to do it, it helps grow the ecosystem, and then there's more stuff there for everybody. So
Okay. Yeah. M. Dale. Yeah. If you want to email our trade desk, if you want us to take a look at something that you got, we'd love to look and see what you got. Help you out with that if you can. Tell you what market is and help you with any other questions you got with creating more owner finance paper in those markets. Our favorite markets are Texas, North Carolina, South Carolina. Indiana has a lot of good stuff. Michigan, kind of the Midwest stuff. We do see a lot of stuff in Florida. Florida and California actually are two big seller finance states. We just
yeah,
don't
I'm
buy a lot in
interested. Do you
California.
guys do much in California? Because I saw that when Fred and Tracy Rui released their list, like California was pretty high up there. But a lot of people, I don't know a lot of people who are active in the state though, because they're afraid of the regulations and such.
Yeah, we have bought notes in California. We don't buy a lot of them just because we're just careful of what uh, somebody might be overselling. Like we'll see a lot of coastal stuff in Florida, like in Miami and other places, and you guys gotta be real careful, especially with condos right now,
Hmm.
because insurance is just going through the roof and skyrocketing. So it makes it really unaffordable to get some of
Yeah.
that stuff on those coastal areas there in Florida. So you just have to be careful and mindful of where you're at, you know. But we have bought recently stuff in California. It's just we're just a little bit more selective and more careful. I'm not the most experienced person in the world, but there's a team of us here that have significant experience in different facets of the real estate markets and in the note market, from residential to commercial, vacant land, multifamily, single family portfolios, one offs, people that understand how to originate paper. Like we've got a really robust group of people that have a ton of experience on all this stuff.
Oh, very, very cool. Well, Justin, man, thanks again for joining. I really appreciate it.
Yeah, you're welcome, Dan. I hope everyone got something out of this little nugget, and feel free to connect with me at the trade desk if you want, and I'll help answer your questions. And yeah, we'll buy land in Minnesota.
Right, awesome. All right, see you guys next time.